and welcome to the 19th episode of the JSE's SA Stock Picks show, where we connect you with investment experts on financial markets to tap into their preferred South African stock picks at the moment. It's a pleasure to be here. If it's here for your first time, welcome. If you have been here multiple times before, welcome back. We're going to kick off 2025 with a bang by speaking about the stock picks of the moment from a South African context, really peeking into the mind of what's top of mind from South Africa's best capital markets investment experts. Now, on the digital channels, we hear you. We are going to have a Q&A towards the end. Please start engaging. Please pose your questions. We are going to circle back to them towards the end of the show. Now, it gives me great pleasure to introduce these four panel experts who are actually going to be taking you through their stocks and preferences of the moment. We'll start with Pietering Redeling-Hicks, also Thembile Bophela, Thamsanqa Netta, as well as Nerina Visser, who all come from different organizations, with Pietri being the founder of Herenia Capital Advisors, Thembile being investment research analyst from FNB Wealth and Investments, Thamsanqa being the CEO of Shiloh Capital, as well as Nerina being an advisor and ETF strategist for ETF SA. Now, looking back, a lot has actually happened in South Africa in the past 12 months that we can talk about. Over 40 elections took place globally across the world. Last year was election year. South African markets themselves were bolstered by the investor confidence that generated outside as a result of the GNU. We also have G20 that is being spearheaded by South Africa this year. And we've had over 250 days with no load shedding, which is a great way to actually start the year. And now starting that, we're actually going to go to our investment experts in order to untap what's top of mind for them, beginning with the CEO, Pietering Redeling-Hicks, who take us through his stock picks for this season. Over to you.
Firstly, thank you so much for having me. And I think just to kind of echo some of the sentiments there, we've had a backdrop of a really positive environment in South Africa for some time now. Imagine keeping the electricity on can boost economic growth, right? So I think we've had a really positive time. I think investor sentiment, well, it's obvious that investor sentiment is improving, even though we saw some results coming through in the last few days, which indicates that consumer spending isn't quite, there yet, but investor sentiment and consumer sentiment is absolutely improving. Plus, if we sort of form a roadmap of what we expect for the future to hold, I think it's a very interesting picture. I'm a big fan of creating these types of roadmaps. So at the moment, we have a situation where I think a series of events that unfolds from here is that, we continue to see interest rate cuts in the US and in South Africa. We probably see an end to the Ukraine-Russia conflict within the next sort of 6 to 12 months, maybe even a bit sooner. And I think that the market takes all of these things as tremendously positive. In the medium to longer term, I think that if we lean on history a bit, you probably see markets pull back some. Historically, interest rate cutting cycles, particularly led by the Fed, generally leads to recessions. So, keep that in mind if you're thinking 6 to 12 months forward. But in the interim, in the shorter term, I think there are some interesting opportunities. So what we'll be looking at, the stocks that we're kind of considering as good investments at this stage really are, they share three things in common, right? They will benefit from the war in the Europe ending. They will benefit from a Trump presidency and rolling back some of the ESG rules that have been made. And essentially, they are on what we think is significant support levels or near significant support levels. So we'll begin with Mondi. If we look at Mondi PLC, it's a share that's been trading on our market for a very, very long time. And if we go back in history and we look at the share price, since around 2015, so for the last 10 years, the price level of 265 Rand has been a significant support level for the stock. It has managed to bounce off of that level again quite recently. I mean, I think in January was the last time it was done there. So we think that this is an attractive level to buy it. And looking at the historic high since 2015, it sort of ranges between 265 and 372. So we think that that's a good time to be invested in the stock for the next year or so. We also think that it has been under a little bit of pressure We think that an end to the war in Europe will probably spur some demand for its products. The same goes for Exxaro. Exxaro has been, I want to say, range bound in for some time. We see the price of 150 Rand level has been support for the stock, also essentially over the last decade almost. So this is Exxaro Resources. So completely different industry, right? However, we think that particularly with the Trump presidency, with the whole, drill, baby, drill type of attitude that's been taken in the energy space, we see that I actually read a very interesting research report saying that green energy is dead for now. I think the world returns to dirtier forms of energy as we essentially stop chasing this ESG narrative as hard as what we have been for some time. And for that, good old-fashioned coal comes back. I also think that we probably see a spur of economic activity, particularly in China, which might spur some demand for thermal coal, for melting, and for steel mills and that type of thing. So Exxaro, I think, is well positioned. We know that they've had a lot of trouble with CEOs resigning recently, and all sorts of investigations. There's an interim CEO. The hunt is on for a new CEO at the moment to permanently take that role. This is all, I want to say, dark clouds hanging over the stock, keeping the share price down at this stage. So that presents an opportunity for us to enter the stock at around 150 Rand or maybe just above, with a 6 to 12 month outlook, sort of trading for the end of the year or buying with the outlook to hold it to the end of the year, but perhaps a bit longer depending on the outcomes of things. And then lastly, we want to highlight Harmony Gold, which is obviously in the gold mining space. We think there's a couple of things happening here. There's, all this positivity I mentioned on the Trump presidency comes with a lot of uncertainty. This has been very good for the gold price. And we think that Harmony Gold is well positioned to take advantage of that. It's had an enormous rally over the last decade. It's currently trading at about 191 Rand. We see that as a support level. And we think that the stock will probably continue to trend higher. We expect the gold price to be up above $3,000 within the next few months, particularly as there's going to be a lot of noise around what does it mean when the war ends? What about a potential recession coming up? We think that this is going to be good for the gold miners. And we can see in the Harmony results as well how their production was impacted positively, how their earnings was impacted positively, all just by keeping the electricity situation stable in South Africa. So looking at the local picture, we think that South Africa is through the worst, right? The government of national unity seems to be holding quite stably. And the sort of socio-political environment seems to be improving. Our economy seems to be improving. So we think that this is, these types of local producers and manufacturers are well positioned to take advantage of that in future.
Thank you so much, Pietri. I have a question around last year's stocks in comparison to this year's. Is there a continuation in some of your stock preferences, or has a lot of the changes and developments that have happened in the last 2 to 3 months really changed your preferences where your stock picks are concerned?
To be honest, not really. We still are quite energy focused. Exxaro isn't necessarily an energy play, but they're both, Exxaro and Harmony are both commodity plays. I guess so is Mondi. It's timber, really. So we're still quite commodity focused. I'll be honest, I had to hold back saying buy Sasol. That is kind of one of those stocks that's kind of haunting me at this stage. 75 Rand. It's just the bottom doesn't seem anywhere near. We still are holding Sasol. We still believe in the stock. So I would say that our views haven't really changed that much. Over the last couple of years, if you've been following along, you'll notice that we've been very heavily sort of going for energy stocks, uranium shares, that type of thing. We still hold those uranium positions, so we're still quite bullish on that. We just think that the energy mix changes a little bit as people kind of roll back this ESG narrative and go back for good old-fashioned dirty energy, which is something that we said we believed would happen for some time now. So that theme really continues. A key distinction, though, I think the market has changed from a buy and hold market into more of an opportunistic traders market, if you will. So you have to actively manage positions at this stage because we feel that, you can't necessarily, Sasol is a brilliant example of this. It bounces 20% sometimes within a couple of days and then just gets absolutely hammered again a few weeks later. So in a market where the volatility is as high as it is important to remain flexible, I think. That said, our general theme remains the same.
Wonderful. So agility is really top of mind. People need to be very focused on their stocks and their portfolio. Something I had omitted to ask you, and I'm actually going to ask everybody else here as well, Pietri, before we continue on to the next person. What was your very first job?
Oh, my very first job.
Yeah.
I packed packets of Pick and Pay, man. I was a packer. That was my first job, and then later I got a bump up to that was the teller for a while, and then I was a waiter and a barman. Sort of worked at a construction company, got fired. The usual.
Very customer friendly. It makes sense
Yes.
now. Thank you so much, Pietri. Going on to you, Stembile, really keen to know what was your first job?
Hi, and thank you for having me. Very excited to be part of the show. So my first job, I was fresh out of university and I got a job as a grad. I was thrown into, being a support to the investment team. And one of the things that I remember from that time was I'm not much of a morning person. I mean, I have evolved through the years, I think, as one does. But yeah, it really was quite a challenge. Just, 6 o'clock in the morning to be at the office by 7, you're already talking, markets and, sort of that go, go, go type of energy. But I think it was a really great opportunity to sort of just get a broad overview of, the investment markets, as it were. And so, yeah, it was very, very challenging, but also very, very rewarding as well.
Love at first sight for you and financial markets. So take us through your stock picks.
Yeah, so my stock picks, I'll start with Coronation. Coronation is one of the largest independent asset managers in South Africa, as we know, in Southern Africa, as we know. They've got a very strong market share. There aren't many pure play fund management businesses on the market, and I'm positive asset management because I think these companies tend to trade in line with market cycles. And while the market could remain quite volatile amid prevailing sort of global geopolitical risks, we do anticipate an improvement in the macro environment, which is generally positive for equities, generally positive for risk assets in general, which I think is going to be a positive underpin for further AUM growth for the business. And in the same breath, I think the easier sort of economic pressures on consumers will likely support an improved sort of savings and investment dynamics across the markets that they operate in. And therefore, I think they'll likely see lower outflows, notwithstanding, of course, the higher withdrawals that we did see following the implementation of the two-pot retirement system. With there are further sort of investment outflows expected from that in the near term, but I think we've seen a moderation in net outflows as a percentage of average AUM in general, which has been encouraging. I think the impact of the two-pot withdrawals should be a one-off sort of major impact with lower withdrawals over time, sort of implying improved outflow trends over the longer term, as I think consumers having more flexibility and access to their savings sooner would likely result in smaller withdrawals sort of on aggregate. And so positive from that perspective. But I think overall, the name itself boasts a very strong long track record of strong cash generation and provides an attractive dividend yield for income-seeking investors as well. So also positive from that perspective. And then moving on to my next stock pick, I do like the Foschini Group, or TFG. Their core business focus is retail and financial services. They have a diverse portfolio across LSM segments and product categories, which I think for them is, a great sort of the diversification across lower, middle, and sort of emerging affluent markets is a positive underpin for them. But it's not just apparel, but it's also, their exposure to home goods and furniture as well. I think better positions them compared to other peers in the market. But it's not just that, it's also They've got geographic diversification with several household brands trading throughout Southern Africa. They've also got exposure to international markets, the UK and Australia. Those markets are pretty similar to the South African market. And they've also been, they face pressure on consumer spending due to the tight macro conditions that we've seen. But in spite of that, we did see the group sort of sustain positive revenue development supported by the expansion of their brand portfolio, but also further growth in the online channel. I think the Bash platform has been particularly doing really well for them with increased engagements. They've seen higher customer retention as well, so positive underpin there. And I think another differentiator for them is their local manufacturing capability. And for that reason, they are a market leader in the quick response strategy, giving them a competitive edge over other retailers who only have offshore factories and therefore longer lead times in their operations. They also have a credit book which as much as they've tightened credit granting criteria because of the macros, I think that staying on the more conservative side, an improvement in the financial conditions for households, which typically supports an increase in credit extension as well as credit quality overall. I think that will, be a benefit for the financial services arm of that business. We do expect, we've seen pressure on consumers in the current environment, but we do expect earnings growth to be underpinned by an improvement in, the macro environment and increased consumption expenditure as, lower inflation and also the continued rate cuts that should follow through over the rest of the year. That should sort of yield higher disposable income for retailers and for Sheeny Group as well, coupled with the cheaper credit, I think will likely spur, consumer appetite quite robustly. And then my last one is Eli Lilly. I picked this for 3 reasons. One, the offshore diversification, investing 101, but also the cost effectiveness of the instrument itself, being able to invest locally in a global company at a relatively low cost, but then also the company itself. Eli Lilly is, one of the major sort of drug makers across, from the US, but they've got international operations. They do have a focus on, the developing, manufacturing and selling of pharmaceutical products, but the portfolio itself, is quite wide ranging and encompassing, the diabetes as well as more recently weight loss. They've also got a focus on cancer, on neuroscience, immunology, cardiovascular treatments as well. But I think the biggest calling card for them, more recently anyways, has been, the heightened demand for anti-obesity and anti-diabetes drugs. It feels like over the past, 5 years, we've either been talking about AI or Ozempic or weight loss. And I think, as much as Ozempic is the popular name in the space, Eli Lilly's GLP-1s, which are brand name Mounjaro and Zepbound, they've had increased market share, significantly outpacing some of the other players in the sector and sort of catching up to Novo Nordisk. But, I think the biggest draw is the sort of investment opportunity in the space. The market for diabetes and obesity treatments is expected to reach, over 70 and 80 billion by the 2030s. And so there's quite a strong demand that has, been outstripping supply for these companies. And that's definitely been quite a strong underpin for their performance over the past couple of years.
Thank you so much, Thembile. And what I particularly like about your preferences is how the everyday layman on the street can relate to a lot of the information that you're talking about. You're walking into a Foschini and you may not understand the group of companies, but you're experiencing it every day. And also to speak about Ozempic is an everyday dinner conversation type of a stock. And so the novice investor can definitely have an appreciation of the stocks that you're mentioning right now. Thank you very much. Thamsanqa of Shiloh Capital, what was your very first job?
Today they are called chores, but when we grew up, they were jobs. My real first job, which earned a salary from, was in a manufacturing factory. They made gaskets, and I was in charge of the stock and other internal audit related activities to make sure systems are working, things are right. So it was quite tedious. It taught me a lot about detail, and when you have to make sure that this role of X input is important as much as that of Y output. So yeah, it was just hard work, but and also dealing with factory people who have grown up and have put in years of really hard work was also quite a great learning experience for me.
Thank you.
Okay, for the business of the day. So I've got three stocks, and the framework I'm going to use is I'm going to give an overview of the stock, then give a few key financial metrics, and then from there I'm going to explain why we believe that this is a good stock to buy, our investment rationale. I think it's also important to note that we are investors in these stocks, so we're not recommending things that we don't own ourselves. So the first stock I'm going to put up is Stadio. Stadio is a tertiary education provider. They were originally part of Curo, and they were spun out of Curo and became their own stock and listed by themselves. Their goal is to make education more accessible to the broader South African and broader African base. They are quite a high generative company. So a few key financial metrics. They had revenue of 1.2 billion in 2024, and we're expecting that to grow this year. They had net profit of 150 million, which is also substantial, and I think it leads to show their business models beginning to find some traction. Their earnings per share was 30 cents, and that's indicative of where they're going. They originally had a capex model where they would acquire universities or campuses, but they're evolving to an online model, which is more profitable. They have a PE ratio of 12, which leads to believe that they are quite a decent growth stock. And our view is, I think the size of the market will enable them to continue to grow. Why do we believe this is a good stock to own? What's our investment rationale? The first is the growing demand. If you think about the metrics, about 800,000 students write matric a year in South Africa, of which about between 48 and 50% of those get bachelor degree passes. So that's about 400,000 students. And of those, only 200,000 get places in universities. So there's a large base of individuals who qualify for university, but don't necessarily have access. So the size of the market is quite significant, and offering innovative campuses and online education supports them. The second thing is the scalability. They are able to scale not just physically, but digitally, and therefore thereby offering a large group of students an opportunity for education. An example of this would be UNISA, where you can study UNISA even if you're overseas. So that kind of gives a larger sort of scope of addressable market. And the large is favorable government policies around tertiary education and support and housing and NEFSAS and that kind of government initiatives, those kind of government initiatives that enable education to be more accessible. The second stock I'm going to pick is Bell Equipment. This is a favorite of ours as we are investors in engineering firms. It's an engineering, they manufacture equipment and distribute equipment that focuses, it's heavy equipment that focuses on mining, construction, and agriculture. They are recognized globally for their articulated dump trucks. We rarely speak about how South African companies can be recognized globally for their innovations and technologies. This is one of the companies that is recognized globally for the equipment that they develop. They have a market cap of just under 4 billion. Revenue is really healthy at 13 billion. Net income of about 750 million. Earnings per share of 7 rands per share, which is quite substantial. And however, they have a PE ratio of 4.7. which shows that they're predominantly undervalued in our view. We believe this is a very good stock to buy, and it'll continue to do well going forward. What is our investment rationale? Firstly, international expansion. They're beginning to supply their equipment globally, especially given that it has received this global recognition. So they are geographically diversified, which is, as Temile said, it's a good thing, investment 101. The second one is product diversification. They've got multiple products across multiple sectors, which gives them a healthy balance sheet, which is point number 3. They've got a very strong balance sheet and are able to continue to expand and be strong. Our third stock, WBHO, one of South Africa's largest construction companies, which is also, call it, established in the UK and Australia. They're really building construction, civil engineering business, road and earthworks, which is also very significant. They have a net asset value of about 4.4 billion, and they have got an order book of about 32 billion, which is quite sizable. The capex they approved last year of about 535 million was structured towards ensuring the company can grow and be ready to service the contracts they've won. What is the investment rationale for this company specifically? WBHO has established reputation not just in South Africa, but in Australia and the UK as well. So they have the capacity to continually win over good contracts, high quality contracts in the infrastructure space. The second thing is there's a lot of commitment towards infrastructure, and they have the capacity to execute. And I think a large part of the books around that will go to them. The president announced 600 billion that will go to infrastructure over the next 10 years. And I suspect WBHO will have some part or a significant part of that. They have diversified operations, different sectors, different geographies. And the key one for us is the technology integration. They use a lot of software in their construction management and build management services, which give them a cost edge over a lot of their competitors. Those are my 3 picks. And again, thank you for having me.
Thank you so much for joining us, Thamsanqa. So I have just one question for you. Has there been any change in your strategy or preferences or approach from an investment perspective between last year and this year?
No, I think we've continued to remain consistent. We prefer the real economy or real assets or companies that address that part of the market. So engineering firms, we really like them. Firms that supply good equipment to mining and agriculture firms. We like agriculture as well. Everyone is running away from primary agriculture, but we are strong investors in that. And manufacturing firms who are making something or beneficiating. I think there's a lot of, call it, inefficiencies that can be changed in companies of that nature with the introduction of good technology and good insights from good operators.
Thanks, Thamsanqa. On YouTube, we can't wait to get to you and interact with you and field some of your questions. Coming up next, Narina, your first job.
Good afternoon, and also to all the viewers, and thank you for this opportunity. Yeah, my first job for which I actually earned some money, and it's not quite just the chores of those, there were lots, but I was actually a piano teacher, or I gave piano lessons to the young girl next door, but I got money for it, so I guess that counts. My first proper paying job for which I earned a salary, I was a rocket scientist. I actually worked for one of the Denel subsidiaries, and I worked on the weapon system of the Rooivalk attack helicopter, of which one was a rocket launcher. So when I say to you that investments and money management is not rocket science, I actually know what I'm talking about.
I feel a lot safer around you, Narina, knowing what you can do now.
I must just warn you that the part of that weapon system was that the gunner on the helicopter had goggles, a sight that actually where he looked, and if he fired, that actually shot. So you must be really careful when I look you very straight in the eye. You know, maybe take some cover. But other than that, yeah, I'm fairly harmless.
Goodness, we're virtual. Maybe we're safer here. Onto your
Indeed.
stocks, Derrida. What's on my top of mind for you?
Thank you so much. Yeah, I think I certainly find myself a lot more comfortable in the investment industry. I've been around for 30 years in this part of the industry. Maybe just going back a little bit in terms of sort of investment themes or outlook. So the last time I participated in the JSE Stock Picks event was in June last year. And already then at the time, we started looking very much more towards a defensive strategy from the perspective of managing downside risk rather than just chasing high returns. You know, we'd come out of an exceptional period, about 2 years of especially the mega tech. We all know about the Magnificent Seven and the extent to which that drove the US equity market, which in turn drove the developed markets and globally actually drove performance quite spectacularly. And as much as we are still in favor of that investment value proposition, we thought that there were many alternatives also. So last year, one of my picks that I had was the UBS Andro World's Biggest Brands portfolio. It's an actively managed certificate listed on the JSE, and that really was in recognition of strong performance still in markets, but we wanted to diversify away from those mega tech companies. And my first pick for today follows on that theme, but it's about moving away from the US dominance and the sort of the US tech dominance and moving into China. So when we look at what's been happening in China from a fundamental perspective, we've certainly seen a couple of false starts in terms of the Chinese government supporting the financial markets through monetary policy, through direct stimulus and so on. But where we find ourselves in the world at the moment, partly also, I think, in response to the escalation around tariff wars and tariffs around the world, we feel that China is quite well positioned from this perspective. And so we feel that it is time for us to actually start moving back into China. Emerging markets as a group have significantly underperformed developed markets for the best part of the last 10 to 15 years. And China has even underperformed the emerging market universe. And we've seen over the last few months that trend has started to change. And we think there's still a lot more to come. So for the South African investor, one of the best ways to buy into China is through a China ETF. Many people might be familiar with the Satrix MSC China ETF, but my particular pick is actually the Signia iTrix China ETF. Offers exposure to exactly the same index as does the Satrix one, but at a third of the price. So we're always in the ETF universe and industry always focused on costs as well. So I do like that. And what will you get when you buy into this particular ETF? Well, it is not just the Hong Kong market. It is a more broad-based China market. So you're going to be getting exposure to the H shares, the P shares, all the R chips, a lot of these sort of shares. The largest exposure is Tencent. So of course, we're very familiar with that through Naspers and Prosus. And so you would actually be adding to some of your South African exposure with this China ETF. But of course, there's a lot more than that. And then Alibaba being the second biggest exposure. And then we move into some probably lesser known Chinese companies for many South African investors, things like Meituan, Xiaomi, China Construction Bank, and so on. And we do think also that just emphasizing sort of the sustainability of the tech theme and the AI theme, that China tech and China AI is very well positioned. So that is my first pick for today. The second one, again, sort of looking back at June last year, where one of the ways in which we wanted to diversify and defend was to move away from these very high growth stocks into something with more of a value orientation. Clearly, that didn't work very well in the last 6 months of last year, but we're certainly seeing some of that coming back. And I specifically exercised that view through the Standard Bank High Street Offshore Yielding Actively Managed Certificate. And that one actually invested in companies or invests in companies, many of them still US companies, but companies that offer a combination of very high dividend yields, but also very high share repurchase programs. So it's a very interesting alternative take on the US equity market from that perspective. And I'm still very comfortable with that one. But this time around, I'm actually moving to a different type of defensive exposure, and that is gold. So Petri, thank you very much for setting the seen in terms of gold. You picked Harmony. I'm going to go slightly broader base and say with an ETF, you can actually get very nice exposure to a diversified basket of mining stocks and in particular gold mining stocks. And interesting then to notice that the Satrix Resi ETF listed on the JSE has changed shape and look quite substantially in recent months. I'm not going to go into the details of the changes to the index methodology, but the fact is that as we stand now today, gold mining companies make up more than 50% of that ETF. And if you add the PGM, the platinum companies to that as well, you're adding another 16%. So you're effectively 2/3 of that investment is just invested in gold and platinum mining companies. And it's something that we think is a very good way to play this current very strong rise that we see in the gold price. Of course, the gold ETF on its own is still a very, very good investment, but we know that gold mining companies provide you, because of operational leverage, a high beta exposure to the gold price. So certainly something that we think it's also seen some good performance in recent weeks, but we think there are still plenty of long legs to this particular investment premise. And then my final pick for today also builds on a theme that I had last year. Last year, I suggested the prescient income provider actively managed ETF called PIP ETF for short, which really tapped into the strong and high interest rates that we have in South Africa, as we have in many other parts of the world. And that is, again, still something that we're very comfortable with. But as Petri has also highlighted, in an environment where one may expect a lowering of interest rates, and I'm going to focus now specifically on the US market in terms of that, you don't want to be invested in short-term or money market in the US market, because you're going to be on the losing end in terms of declining interest rates. But when we look at what Trump and his administration is targeting and what they're focusing on, I took particular interest in Scott Bessent's 333 plan. Now, he's the Treasury Secretary, I guess almost the Enoch Godongwana of the US. And the 333 plan that he's put forward really focuses, it's easy to remember because of the threes. The first one is that he wants to reduce the budget deficit from 6% to 3%. The second thing is, it comes back to the drill, baby, drill, to increase oil production in the US by 3 million barrels a day. And the third three is to sustain 3% economic growth by cutting taxes. Now, Scott Bessent and Trump does not have the ability to dictate the short-term interest rate in the US. That is the purview of the Federal Reserve. But what they are targeting in this is the 10-year bond yield. Let's remember, Trump is first and foremost a property tycoon before he is the president of America. And I certainly don't expect him to do anything that will hurt his main business. He's going to go back to that after his term in the White House ends. So they are targeting the 10-year government bond yield. And for the South African investor, the best way to actually get exposure to that is through the FNB Dollar Custodial Certificate. DCC USD is the share code on that one. And that actually buys 10-year US government bonds. You buy it in rands on the JSE in South Africa, and it really allows you to participate in that benefit that would be experienced, a capital gain that you would get from the reduction in the yield on the 10-year bond yield. Price goes up when the yield goes down, and that's my final pick for today.
Thank you so much, Nerina. And I think we have learned so much about each other today, over and above the stock picks. I now don't know if I should be terrified of you, if I should feel better that you're in my life. I know the best person to pack plastics and to be my teller is Petri. I know it was love at first sight for capital markets with Tembile. And I know if ever I need someone to pack with me, Tamsanga is my guy, because we both are kindred spirits where box packing is concerned. I have a very similar humble background. Now, thank you everybody who is actually listening in from home. We have been fielding your questions and we're really happy to actually share these with our experts here today. And the first one goes to you, Petri. And the question is, sir, why Harmony and not Goldfields or Anglo Gold Ashanti?
Well, that's more sort of down to technical analysis, really. So we just prefer the way that the Harmony Gold chart looks for us at this stage. And we think we've got a good we've got a good entry point. So, I mean, on the day right now, as we speak, it's down around 2.76%, so almost 3%. If you look at the chart, you put a daily chart on, you put on a 200-day moving average. That moving average is around 180 Rand at this stage. If you kind of really zoom out of that chart over a long period of time, you'll see that from around 2023 or December 22, essentially that trend changed to upwards, and that 200-day moving average has been acting as a support level ever since. And yes, from time to time, it kind of breaks beneath it for a little while, but for the most part, it's been acting as support. It's recently bounced off of that level at 180. A little bit of weakness here. We think over the next couple of days, we might dip below it again, maybe as low as 170. That would be a very attractive buying opportunity, I think, for those who aren't in the stock yet. And just generally, it's trending very, very strong. I suppose you could look at a Goldfields or any of the other mining counters. Narina's suggestion of taking exposure to ETFs is also a very good idea, much lower risk. So in general, I think we're kind of agnostic about which gold stock. Some are run better than others. We just happen to like Harmony the most. But if you want a bit of a more diversified bet, then I guess you could go for something like an ETF. Would probably be a very good call. You could also consider even just like a Satrix New Gold. Something like that could be a good, like some sort of a ETF or something. Just bucking the pure gold price would be a good call as well, I think.
Thank you so much, and thank you for bringing Narina's recommendation up as well. Definitely a great option where people want to have risk diversification, where people are uncertain in terms of which option in the gold industry they should actually be investing in, where people want to have certain components across the industry as opposed to one particular gold one. What's also important as well, there's such a diverse range of investor styles and strategy styles when it comes to investing. We have your long-term investors, we have your fundamental analysis investors, we have your swing traders, scalp traders, position traders, who may use momentum, fundamental, different strategies that depend on the person and the preference and their style. So that's what we love about investing as well as trading. There's so many different ways to analyze a financial instrument and to come to a preferred outcome. So both are an option that a person should consider in alignment with their style. Also just highlighting not investment, not financial advice, as had mentioned earlier on in the episode. Mr. Netta, we have been asked Stadio Holdings versus Advitech versus Curro. Why did you decide the way that you decided in that stock?
Ironically, we hold all three. So I didn't decide. I just couldn't pitch 3 education businesses at one go. But we're really bullish on the education sector in South Africa. You can pick either of. The key difference is Curro focuses more on secondary school and primary school education. And I think that has a sector with its own unique challenges, and Curro is addressing them. It's quite a capital-heavy business in the sense that to take over a school or to build schools is significant, and a lot of money will be spent there. The other two, Advitech and Stadio, I think they offer great access, and I think that's the key element that we need to keep hammering on, is that they are providing access to individuals and students who previously didn't have. So in reality, if you have appetite for capital expenditure in education, then Curro would be part of the portfolio. But if you don't, the more online and call it campus-based education that Stadio and Advitech hold would also be great. But we hold all three. We're quite bullish on the sector.
Thank you so much, Thamsanqa. A lot was actually said there to the person who had asked that question. They are targeting different age groups when it comes to education. There's demand and supply issues that are varying depending on whether it's a high school student versus a tertiary student. There's investment capital overlay that's impacting the one organization more than it's impacting another organization. So those are some of the fundamentals that were mentioned. And then it also goes into a preference to say from a profitability perspective. Therefore, if you're not having the same kind of infrastructure overlay investment that you're going to have, then Stadio is the one that was mentioned. However, all three are actually in his portfolio. He didn't mention all three because we had only mentioned 3 per person. But depending on your investor appetite, your patience as well, your time overlay, your risk appetite, you may decide how much to invest in all 3, whether to invest in all 3, and which one is your favorite from all 3 as well. Then we also have a question for you, Nerina, our rocket scientist / pianist. Nerina, I thought you were going to suggest a gold ETF is what this person had mentioned.
So as I said, absolutely still very comfortable with a gold ETF as well. And in South Africa on the JSE, we've got the Absa New Gold ETF. By the way, it has already been listed on the JSE for more than 20 years. So it's got an exceptionally long track record. And then One Invest also has a gold ETF. And either of those would be great options if you're wanting to buy exposure to the physical gold. The investment case for investing in gold mining companies really relates to the operational leverage that they have. And that's where Petri had suggested Harmony or even Goldfields and AngloGold Ashanti. My recommendation for the Satrix Resi incorporates all 3 of those gold companies. And when we talk operational leverage, so clearly as the gold price moves up, so the earnings of the companies move up by a greater margin, and then vice versa, exactly as Petri had also explained it to us. And I think in South Africa, we're coming out of a period where there was certainly a lot of drag from an operational perspective on South African gold mining companies, where you had the challenges around load shedding, where there's issues around wage negotiations, labor disputes, and so on. And those are all factors to take into account. But in an environment where we see this improved business confidence, investor confidence, certainly much lower levels of load shedding, it means that the operational leverage becomes a positive driver to that. And so for investors with the necessary risk appetite, I would certainly suggest the gold mining companies rather than the gold ETF, which is the physical, the bullion. But if you are less risk seeking or you have a lower risk appetite, then the gold ETF is a brilliant way, not just to provide some downside risk in terms of that, but really to sort of have a hedge against, I think, a whole range of global risks that we are currently very, very well aware of.
Thank you so much, Nerina. And to Nerina's point, risk management remains a critical component of any sound investment portfolio or trading strategy. So please do take that into consideration. A final question that's been asked that I think is actually for me is, are there any stockbrokers that offer JSE listings in South Africa besides local banks? And the answer to that is yes. Over and above local banks, there are many registered stockbrokers that are available in South Africa for different ways in which to invest in South African shares. Please feel free to go to www.jse.co.za, go to For Me, and then you will find a list of JSE brokers. What you also have as well is you could also go into your FISCA website to go to www.fsca.co.za and put together an FSP number and actually verify whether or not the institution that you're engaged with is actually a registered financial services provider. So there are many ways and many organizations. Just make sure that they are either a JSE registered members or they are registered FSP providers before you engage them to mitigate your risks of investing in unregistered institutions. So I'm just going to allow each of our guests closing remarks, and then I'll close off today's episode, starting with you, Petri.
All right. Sorry. Thanks for the opportunity. So I think closing remarks is really just around, I guess, what our expectation is for the next year, right? So we're a big fan of creating these types of roadmaps. So over the last year, we thought that we'd probably see interest rate cuts. We'd probably see a Trump victory. Now, much of that sort of water has passed under the bridge. So it's time to kind of create a roadmap for the next 12 months. So our roadmap at this stage includes, continued rate cuts, an end to the war, and potentially a recession in maybe the second half of the year. We know that historically, and this is bad news, right? This is not the news people want to hear, but I think if you are a long-term investor or new to markets, a bear market is the biggest gift that you can get as a long-term investor, right? At the end of the day, what happens is if you go back and you look at 2008, which was a global financial crisis, the markets pulled back 50% or whatever it was. It's a blip on the radar today, right? If you look at the COVID crisis, or COVID crunch, whatever you want to call it, that was, I think, over 30% of the markets came off in a couple of weeks. You can hardly see that on the chart today. So if there are these bear market periods in time where asset prices come down, step one, rule one, don't panic, right? Rule two, if you can afford to, buy more. That's your opportunity. And then if you do diversified investments like ETFs, for example, or even unit trusts, or you can be a bit more risk taking and buy individual shares. It is an opportunity for you to make the most of that. So I think that's something that we have to really just keep in mind. So on our roadmap for the rest of the year, the war in Europe ends. We think it's going to be great for commodities. We think that's going to be great for emerging markets is something that will benefit really well. We think that we see developed markets underperform emerging markets for the next couple of years. I think it's a view that some of the other panelists here in Arena, for example, shares. And we think that also if you correlate, when commodities do really well, it's generally when financial markets do really poorly. So we think kind of avoid tech for now, be a bit more resource commodity heavy, and prepare for a bumpy ride. It's going to be an interesting year.
Thank you so much, and thank you for that. Stembile, over to you.
Hi, thanks again for having me on the show. I've had an amazing time, and I feel like I've also learned so much as well, as much as I've also shared. So yeah, closing remarks from my side. I think just echoing what you said earlier, part of my stock picks was centered around focusing on investing in what you know. Go back to basics. The market is quite uncertain. There's a lot of volatility. And so I think in this market, you definitely want to focus on investing in quality over, sort of speculative. And so I think, yeah, definitely in this market, remember the basics and stick to your guns, basically. Yeah.
Thanks, Stembile. Thamsanqa?
Three. The first is to say thank you again for having us. I always appreciate these opportunities. The second is to echo the risk management statements made by all parties involved. I think it's important to make sure you use a trusted advisor who understands the markets and can be held liable for any misdemeanors by the governing bodies. And then the third, governing bodies being FSCA and the central bank on the banking side. So you need to make sure you understand. Then the third is a shameless plug to say if you are a family business in manufacturing, agriculture, engineering, and you're looking to exit, please give us a call.
Thank you, Thamsanqa. And over to you, Nerina.
Thanks so much. Yes, I think I would like to maybe just end off by focusing on the opportunities that the JSE as your investment platform offers you as the investor. And if up until now, your main focus on the JSE has been buying individual stocks that are listed on the JSE, I want to encourage you to explore the amazing opportunity set that exchange-traded products give you. Within this, we talk ETFs, exchange-traded funds, ETNs, exchange-traded notes, actively managed certificates. We talk about these things, but as it stands, we now have almost 260 of these listed on the JSE. So probably a much better opportunity set than the individual shares offer you. And in almost illustration of that also is that opportunity set is absolutely global and it's across asset classes. It's not just equities. And maybe to demonstrate that, to pick up on Sitebele's her one recommendation being Eli Lilly. For the investor who does not have an offshore brokerage account, you can actually buy Eli Lilly on the JSE in rands at a very affordable price also, because it's effectively a fractional component of that. FNB offers exchange traded notes with Eli Lilly as the underlying investment that you get. And you can even choose whether you want to get the full rand dollar exposure, whether you effectively want to have that hedged out. So if you also hold the view that the rand is going to strengthen or the dollar is going to weaken because of the global outlook as we have it, you're actually able to effectively hedge that out. So I always use the analogy to say I love Belgian chocolate, but I prefer buying it in my local Spar rather than having to get on a plane and at great expense go and buy it all the way in Belgium. The JSE is exactly the same. The JSE offers you the opportunity to buy that amazing Belgian chocolate, but in the safety and the comfort and the familiarity of your local Spar.
Thank you, Nerina. What a fascinating session. We've had a various diverse range of financial instruments we've spoken about, from stocks to ETNs and ETFs. And we thank all our investment professionals for making the time. And we thank you to all our guests as well for asking the questions in terms of stocks. Please do apply your risk management, use appropriate registered stockbrokers, and we wish you much success on your trading and investment journey. See you again in episode 20. I'm Nongalego Bushe, Head of Retail and Business Development at the Stock Exchange. A pleasure for having you join us today. See you soon.